Welcome to this explainer. We're going to completely decode Sustainable Development Alignment today, and our goal is to transform it from this vague, fuzzy charity concept into a hardcore balance sheet strategy for Nigerian businesses. I'm so glad you're joining us, because honestly, this is the defining strategic challenge for this entire generation of business leaders. We are going to dig right into the specific frameworks that determine exactly who gets investment, who secures the big contracts, and ultimately, who is actually going to survive the next decade. To make sure we master this efficiently, we've broken this down into a 5-part syllabus. We'll start by looking at Nigeria's climate paradox. Then we'll unpack the 5 components of alignment, dive into the Access Bank case, explore real-world Nigerian applications, and wrap it all up with the MIVIA exam formula. Let's get right to it.
Starting with Section 1, Nigeria's Climate Paradox. This is the macro reality you really have to wrap your head around before we even touch a single corporate framework.
Think about this stark paradox for a second. On one hand, you have a country that pumps roughly 1.5 million barrels of crude oil every single day. Literally, the entire federal budget depends on it. But on the other hand, under the Paris Agreement and its updated NDC 3.0, this exact same country has formally pledged a 29% cut in greenhouse gas emissions by 2030 and net zero by 2060. The government has this huge plan to phase out routine gas flaring and push renewables, all while trying to run an economy where the national grid still collapses on a weekly basis. That intense friction between daily oil dependence and future climate targets is the reality we have to navigate.
Now, before we start throwing around formal corporate terminology, I want to introduce you to Mama Chidinma. She runs a profitable organic vegetable oil stall in Onitsha main market. She presses her own palm oil, which means zero diesel. She pays her market assistants above minimum wage because she knows they have families to feed. And every single week, she sets aside a little money for the local Women's Flood Relief Fund. Look, nobody taught Mama Chidinma formal sustainability frameworks. She is just naturally living these principles. She measures her success by counting her actual impact on her community and her environment, not just looking at her daily profit margin.
Section 2, the 5 components of alignment. Let's transition from the market stall straight to the boardroom and systematically break down the 5 formal components of sustainable alignment.
Component number 1 is a real game changer. It's the triple bottom line. Back in 1994, John Elkington introduced this framework, and it completely revolutionized accounting. The core argument is simple, but it's devastating. Businesses that only count financial money are literally just measuring 1/3 of their actual impact. If a business maximizes financial returns by dumping costs onto society, like Shell's historical gas flaring in the Niger Delta, it ultimately bankrupts its true bottom line. Sure, revenue looks great initially, but it gets completely wiped out later by massive costs from militant insurgency, environmental health damage, and endless litigation.
So, you absolutely have to track performance simultaneously across 3 distinct accounts. First, you've got profit, which is your standard economic value and revenue. Simple enough. But right alongside it, you must track the people account. That covers social value, labor standards, wages, and community impact. And third, the planet account, which diligently tracks environmental impacts like your carbon emissions, your water use, and biodiversity. You simply cannot externalize costs from one account just to artificially inflate another.
That brings us to component 2. In 2015, the United Nations took this exact logic and scaled it globally, giving us the 17 UN Sustainable Development Goals, or SDGs. They replaced the old Millennium Development Goals and now cover everything from no poverty under SDG 1 to clean energy in SDG 7, all the way to climate action in SDG 13. But here is the big takeaway. Achieving these 17 goals requires closing a massive $2.5 to $3 trillion annual financing gap. Governments just do not have that kind of money. It requires massive private sector capital to step in.
Component 3 is materiality. Now, you don't just randomly claim you're supporting all 17 goals. That's not how it works. Frameworks like the GRI dictate that you strategically target the goals that directly intersect with your specific value chain. Let's compare 2 giants. Access Bank naturally prioritizes financial inclusion under SDG 8 and gender equality under SDG 5. Meanwhile, Dangote Cement focuses heavily on industrial infrastructure under SDG 9 and responsible production under SDG 12. Having that materiality discipline is exactly what stops sustainability from devolving into just a cheap PR exercise.
Component 4 is the one you probably hear everywhere, ESG. Now, this isn't some brand new separate theory. It's simply the investment industry's way of operationalizing the triple bottom line into scorable criteria. Investors need hard metrics. They want to track carbon intensity for environment, gender pay gaps for social, and board independence for governance. If a Nigerian company wants access to IFC capital, European Development Finance, or UK green bonds, adopting standard reporting frameworks like SASB and TCFD to prove their ESG compliance is not optional. It is the absolute price of admission.
Moving right along to Section 3, the Access Bank case study. Let's look at the ultimate Nigerian example of institutional SDG alignment to see exactly how this plays out in practice.
Let's map out Access Bank's journey. It all starts in March 2019. They issued Africa's very first Climate Bonds Initiative certified corporate green bond for 15 billion naira, directly targeting renewable energy under SDG 13. And they scaled this incredibly fast. By 2022, they're issuing a $1.5 billion global note on the London Stock Exchange. Cut to 2024, and they've expanded their SDG-aligned programs across 10 different African countries, tackling everything from gender lending to massive mangrove restoration projects in Gambia.
But here is the absolute crucial demystification moment of this entire explainer. Access Bank is not doing this just because they have extra money lying around for charity. They do it because CBI-certified green bonds unlock significantly cheaper capital. By aligning with these strict standards, they attract legally mandated European pension funds and US ESG investors who are literally forbidden from deploying capital into non-ESG instruments. This alignment is, at its core, a treasury strategy designed to lower their cost of funds.
Section 4. Real-world Nigerian applications. Let's dig into Component 5, building actual SDG business models, and examine how this framework operates across various real-world Nigerian sectors.
The pressure to align isn't just trickling down from global investors or government regulators. It is happening on the ground right now. Take a look at this real testimony from a Nairaland user. A local printing company in Ogba nearly lost a huge contract with a multinational FMCG simply because they didn't have an ESG policy document. Giant multinationals like Unilever and the Nigerian Bottling Company now strictly demand ESG credentials and materiality matrices baked right into their supplier codes of conduct. If you want their business, you absolutely need the paperwork to back it up.
Over in the energy sector, let's look at Daystar Power. They built their entire commercial revenue model around SDG 7. By replacing incredibly expensive diesel generators, which we can treat as our 100% cost baseline, with their solar-as-a-service model, Daystar reduces their clients' energy costs by about 30%. They charge per kilowatt-hour, dropping carbon emissions measurably, all while running a highly profitable, scalable business. SDG 7 isn't some philanthropic side project for them, it is their core product.
These frameworks literally apply everywhere. Look at Civic Tech. Budget treats the people account and SDG 16 as its entire organizational mandate by strictly tracking government accountability. In manufacturing, you have NASCON tracking their water and energy intensity under SDGs 6 and 12. And they aren't doing it for show, they are doing it to aggressively cut production costs and qualify for green finance. When you successfully align sustainability with profitability, your business can scale rapidly.
Which brings us nicely to Section 5, the MIVA exam formula. Let's crystallize everything we've just covered into a highly structured formula you can deploy. Whether you're in an exam or presenting to a boardroom, use this exact 5-step playbook. Step 1, define the core theories, the triple bottom line, and the SDGs. Step 2, model them through materiality assessments in GRI or SASB frameworks. Step 3, apply them using concrete, local examples like the Access Bank Green Bond or Daystar Solar Model. Step 4, contextualize the unique Nigerian friction. And finally, Step 5, conclude strongly on the financial and strategic imperative. Structure your arguments this way and you prove you deeply understand the mechanics.
I want to pause on Step 4 for a second because it is absolutely critical. You cannot just copy-paste European models and expect them to work flawlessly here. You must highlight Nigeria's unique friction constraints. We are dealing with a massive off-grid infrastructure deficit. We have a staggering financing gap where 80% of our climate targets completely depend on international finance. We have to navigate severe regulatory fragmentation across multiple agencies like NESREA, NRC, DPR, and NAFTEC. And we face a huge measurement gap because unlike the EU, we don't have a mandatory standardized reporting directive yet. Acknowledging this friction shows real strategic maturity.
Okay, let's do a quick mental quiz to test your understanding. Imagine you're in a meeting and a manufacturing CEO dismisses ESG, calling it just a burdensome reporting compliance cost with zero strategic value. Based on everything we've covered today, what 4 strategic dimensions is this CEO completely missing?
Here is exactly why they are fundamentally wrong. ESG is a hardcore financial imperative. First, it unlocks cheaper, preferential capital, like green bonds. Second, the materiality process surfaces hidden operational liabilities, things like waste and water costs, that a traditional P&L completely hides. Third, as we saw with that Nairaland user, it protects your status in vital multinational supply chains. And fourth, it actively lowers your credit risk premium under the central bank's sustainable banking principles. It is so much more than just a reporting exercise.
So what is the ultimate takeaway from this explainer? It's this. Sustainability is not a charity line item. It is a balance sheet strategy. The businesses that are diligently measuring their carbon footprints and building their people and planet accounts today, long before the regulators bang on their doors, are going to be the exact ones that survive tomorrow's transitions.
As we wrap up and look ahead to our next topic on creating shared value, I want to leave you with this final, provocative thought to take back to your teams. Is your organization proactively tracking all three bottom lines right now, or are you just waiting for non-alignment to permanently close commercial doors when it's already too late? Thank you so much for joining me for this explainer, and stay sharp.